Question 1. Which regulatory body is primarily responsible for the day-to-day oversight and enforcement of rules for retail foreign exchange dealers, or Feds, and their associated persons in the United States? A. Securities and Exchange Commission, SEC. B. Financial Industry Regulatory Authority, FINRA. C. National Futures Association, NFA. D. Commodity Futures Trading Commission, CFTC. Answer: C. National Futures Association, NFA. Explanation: the National Futures Association, NFA, serves as the self-regulatory organization, SRO, for the U.S. derivatives industry, including retail foreign exchange. While the Commodity Futures Trading Commission, CFTC, establishes the overarching federal regulatory framework, the NFA is tasked with implementing and enforcing specific rules, conducting examinations and registering RFEDs. Understanding the NFA's role is critical for firms and individuals operating in the retail forex market, as compliance with NFA rules is mandatory. This structure ensures a layer of self-governance under federal oversight. Question 2. A retail forex customer opens an account and deposits $10,000. If the dealer requires a 2% margin for major currency pairs, what is the maximum notional value of a long euro to US dollar position the customer can open? $100,000. B. $200,000. C. $500,000. D. $1 million. Answer: C. $500,000. Explanation: margin in retail forex trading refers to the amount of money required to open and maintain a leveraged position. To calculate the maximum notional value, you divide the account equity by the margin requirement. $10,000/0.02, or 2%, equals $500,000. This illustrates the significant leverage available in forex, where a relatively small capital outlay can control a much larger notional amount. While leverage can amplify profits, it equally magnifies potential losses, making robust risk management essential for all traders. Question 3. Under NFA rules, an RFED is generally permitted to offer leverage of up to what maximum for major currency pairs to eligible retail customers? 25:1. B. 33:1. C. 50:1. D. 100:1. Answer: C. 50:1. Explanation: NFA rules for retail foreign exchange dealers, or Feds, generally cap the maximum leverage offered to retail customers for major currency pairs at 50:1. For non-major currency pairs, the leverage limit is typically 20:1. These leverage restrictions were put in place to help protect retail customers from excessive risk exposure, as high leverage can lead to rapid and substantial losses. It is crucial for RFEDs to adhere strictly to these margin requirements and for customers to understand the implications of leverage on their trading capital. Question 4. Which of the following activities is strictly prohibited for an RFED under NFA rules regarding customer funds? Holding customer funds in an omnibus account. B. Using customer funds to meet the RFED's operating expenses. C. Maintaining customer funds in a bank outside the U.S. D. Investing customer funds in highly liquid government securities. Answer: B. Using customer funds to meet the RFED's operating expenses. Explanation: NFA rules mandate that retail foreign exchange dealers, or Feds, must treat customer funds as segregated and are strictly prohibited from using them to meet the firm's operating expenses or for proprietary trading. This segregation requirement is a fundamental investor protection measure, ensuring that customer assets are distinct from the firm's assets and are available for withdrawal even if the firm faces financial difficulties. While holding funds in an omnibus account or in specified foreign banks might be permissible under certain conditions, the misuse of customer funds is a severe violation. Adhering to strict segregation rules is paramount for maintaining customer trust and regulatory compliance. Question 5. An RFED must disclose specific information to prospective customers, including a risk disclosure statement. Which of the following must be explicitly highlighted in this disclosure? A. Guaranteed profits for disciplined traders. B. The low risk associated with major currency pairs. C. The potential for losing more than the initial deposit. D. The absence of market manipulation in the forex market. Answer: C. The potential for losing more than the initial deposit. Explanation. A comprehensive risk disclosure statement is a mandatory document an RFED must provide to prospective retail forex customers. This disclosure must explicitly highlight the potential for losing more than the initial deposit, which is a critical risk associated with leveraged trading. It must also detail risks such as market volatility, the impact of leverage, and the speculative nature of forex. RFEDs are prohibited from making claims of guaranteed profits or downplaying risks, underscoring the importance of transparent and realistic risk communication to clients. Ensuring customers fully comprehend these substantial risks is a cornerstone of investor protection. Question 6. In the context of retail forex, what does rollover primarily refer to? A. The process of transferring an account from one RFED to another. B. The adjustment made for holding an open position past the daily market close, typically 5 p.m. Eastern Standard Time. C. The act of converting one currency to another without opening a new position. D. The automatic renewal of a futures contract before its expiration. Answer. B. The adjustment made for holding an open position past the daily market close, typically 5 p.m. Eastern Standard Time. Explanation. Rollover in retail forex refers to the interest adjustment applied to open positions held overnight, specifically past the end of the New York trading session, typically 5 p.m. Eastern Standard Time. This adjustment, often called a swap or financing charge/credit, reflects the interest rate differential between the two currencies in a pair. Depending on the direction of the trade and the interest rate differential, a customer may either pay or receive a small amount of interest. Understanding rollovers is important as it impacts the cost of holding positions for extended periods and can influence trading strategies. Question 7. Which of the following NFA rules directly addresses advertising and promotional material used by RFEDs? NFA Compliance Rule 2-4. B. NFA Compliance Rule 2-29. E. NFA Compliance Rule 2-36. D. NFA Financial Requirements Section 11. Answer. B. NFA Compliance Rule 2-29. Explanation. NFA Compliance Rule 2-29 specifically governs the advertising and promotional material used by NFA members, including retail foreign exchange dealers, or FEDs. This rule ensures that all such communications are balanced, not misleading, and contain necessary risk disclosures. It aims to protect customers from deceptive practices and ensure they receive clear and accurate information about forex trading. Adherence to Rule 2-29 is crucial for RFEDs to maintain ethical marketing practices and avoid regulatory penalties, underscoring the NFA's commitment to investor protection. Question 8. An RFED receives a large wire transfer from a customer located in a country identified by FINRA as having inadequate anti-money laundering (AML) controls. What is the most appropriate initial action for the RFED? A. Process the transaction immediately to avoid delaying customer funds. B. Contact the customer to verify the source of funds and the purpose of the transaction. C. Inform the NFA directly before processing the transaction. D. Close the customer's account immediately to mitigate risk. Answer. B. Contact the customer to verify the source of funds and the purpose of the transaction. Explanation. Upon receiving a suspicious transaction, especially from a high-risk jurisdiction, the most appropriate initial action for an RFED is to conduct enhanced due diligence. This includes contacting the customer to verify the source of funds and the purpose of the transaction, as part of the RFED's anti-money laundering (AML) program. If the transaction remains suspicious after inquiry, the firm would then typically file a Suspicious Activity Report (SAR) with FINRA. Simply processing or immediately closing the account without investigation may not meet AML obligations. Proactive due diligence is key to combating illicit financial activities. Question 9. What is the primary purpose of a guaranteed stop-loss order in retail forex trading? To ensure a specific profit level is achieved regardless of market movement. B. To limit potential losses by closing a position at a specified price, even if there is a market gap. C. To automatically reopen a position if the market moves favorably after being stopped out. D. To lock in an exchange rate for a future transaction. Answer. B. To limit potential losses by closing a position at a specified price, even if there is a market gap. Explanation. A guaranteed stop-loss order is a risk management tool that ensures a position will be closed at the exact price specified by the trader, irrespective of market volatility or gapping. Unlike a regular stop-loss order which might execute at a worse price, slippage, during rapid market movements, a guaranteed stop-loss removes this slippage risk. While typically incurring a small premium or wider spread, it offers certainty in limiting potential losses, which is especially valuable in highly volatile markets. This feature is crucial for traders seeking precise control over their downside risk. Question 10. An RFED must provide customers with account statements at least daily, B. weekly, monthly, D. quarterly, C. monthly. Explanation. Under NFA requirements, retail foreign exchange dealers, or FEDs, are obligated to provide customers with account statements at least monthly. These statements must clearly detail all trades, deposits, withdrawals, fees, and the overall financial status of the account. This regular reporting ensures transparency and allows customers to monitor their trading activity and account balances effectively. Providing timely and accurate statements is a fundamental aspect of an RFED's responsibilities and contributes to sound customer relations and compliance. Question 11. Which term describes the difference between the bid and ask price of a currency pair? Margin, B. leverage, C. swap, spread. Answer, spread. Explanation. The spread is the difference between the bid buy price and the ask sell price of a currency pair, and it represents the primary cost of executing a trade in the forex market. When you open a buy position, you pay the ask price, and when you open a sell position, you receive the bid price. RFEDs and brokers earn their revenue from this spread. Understanding the spread is fundamental for calculating trading costs and evaluating the competitiveness of different forex dealers. Question 12. What is the maximum penalty the NFA can impose on a member for a significant rule violation? A fine of up to $100,000 per violation. B. Suspension of registration only. C. Expulsion from NFA membership and permanent bar from the industry. D. A fine of up to $500,000 per violation, expulsion, suspension, or other appropriate action. Answer. D. A fine of up to $500,000 per violation, expulsion, suspension, or other appropriate action. Explanation. The NFA possesses broad disciplinary authority to ensure compliance with its rules and federal regulations. For significant rule violations, the NFA can impose severe penalties, including fines of up to $500,000 per violation, suspension, expulsion from NFA membership, and permanent bars from the industry. These substantial penalties underscore the NFA's commitment to maintaining market integrity and protecting retail forex customers from misconduct. RFEDs and associated persons must recognize the serious consequences of non-compliance with NFA rules. Question 13. An RFED's compliance officer is reviewing promotional materials. Which statement, if found, would be a violation of NFA advertising rules? A. Forex trading involves substantial risk and is not suitable for all investors. B. Our platform executes trades with an average spread of 1.5 pips on euro to US dollar. C. Past performance is not indicative of future results. You could lose all your capital. D. Earn consistent profits with our proprietary trading algorithm, guaranteed to beat the market. Answer. D. Earn consistent profits with our proprietary trading algorithm, guaranteed to beat the market. Explanation. NFA Compliance Rule 2-29 strictly prohibits RFEDs from making misleading statements or claims of guaranteed profits in their promotional materials. Statements such as, guaranteed to beat the market, or promising consistent profits are deceptive and violate the requirement for balanced and fair advertising. Promotional materials must always include prominent risk disclosures and avoid implying that trading success is easy or assured. Ensuring all marketing communications are truthful and not misleading is paramount for an RFED's compliance program. Question 14. What is the primary characteristic of a spot forex transaction? A. It involves an agreement to exchange currencies at a future date at an agreed-upon rate. B. It is an exchange of currencies for immediate delivery, typically within 2 business days. C. It refers to the speculative trading of currency futures contracts. D. It is a transaction involving physical delivery of currency notes. Answer B. It is an exchange of currencies for immediate delivery, typically within 2 business days. Explanation. A spot forex transaction is characterized by the exchange of one currency for another for immediate delivery, typically settling within 2 business days, T+2. This contrasts with forward or futures contracts, which involve agreements for future delivery. Retail forex trading primarily involves spot transactions, where traders speculate on currency price movements in the near term. Understanding this immediate settlement characteristic is fundamental to comprehending the mechanics of the retail forex market. Question 15. Which of the following would not be considered a major currency pair? Euro to US dollar. B. Pound sterling to Japanese yen. C. US dollar to Canadian dollar. D. Australian dollar to US dollar. Answer B. Pound sterling to Japanese yen. Explanation. Major currency pairs typically involve the US dollar USD, and other highly traded currencies like the euro, Japanese yen JPY, British pound GBP, Swiss franc CHF, Canadian dollar CAD, and Australian dollar AUD. While pound sterling to Japanese yen is a popular and liquid cross-currency pair, not involving USD, it is generally classified as a cross or minor pair, not a major pair. Major pairs are characterized by the highest trading volumes and typically lower spreads. Identifying major versus non-major pairs is important as margin requirements can differ. Question 16. Under NFA Financial Requirements Section 11, an RFED must maintain adjusted net capital equal to or exceeding what amount? $500,000. B. $1 million. C. $20 million. D. $50 million. Answer D. $50 million. Explanation. NFA Financial Requirements Section 11 mandates that retail foreign exchange dealers, or FEDs, maintain adjusted net capital of at least $50 million. This substantial capital requirement is designed to ensure that RFEDs are adequately capitalized to withstand market volatility and meet their obligations to customers, thereby enhancing customer protection. This high threshold serves as a significant barrier to entry, ensuring that only robust and financially stable firms can operate as RFEDs. Compliance with net capital rules is continuously monitored by the NFA. Question 17. An RFED determines that a prospective customer does not fully understand the risks associated with retail forex trading, despite providing the required disclosures. What is the RFED's obligation? A. Proceed with account opening as long as the customer signs the disclosure. B. Inform the customer of their concerns and refuse to open the account until understanding is confirmed. C. Suggest the customer start with a small deposit to limit risk. D. Refer the customer to a financial advisor for independent counsel. Answer B. Inform the customer of their concerns and refuse to open the account until understanding is confirmed. Explanation. NFA Compliance Rule 2-36D requires RFEDs to obtain a signed risk disclosure statement and prohibits them from opening an account if they have reason to believe the customer does not understand the risks. Therefore, if an RFED believes a prospective customer does not fully grasp the risks, they must inform the customer of their concerns and refuse to open the account until understanding is confirmed. This Know Your Customer and risk comprehension obligation is a crucial investor protection measure, preventing unsuitable individuals from engaging in high-risk trading. The RFED's responsibility extends beyond merely providing disclosures to ensuring actual comprehension. Question 18. Which of the following is an acceptable method for an RFED to offset customer forex transactions? Entering into futures contracts on a regulated exchange. B. Netting customer transactions internally as a principal. C. Placing offsetting trades with a liquidity provider. D. Holding all customer positions unhedged. Answer C. Placing offsetting trades with a liquidity provider. Explanation. RFEDs typically offset customer forex transactions by placing offsetting trades with one or more liquidity providers in the interbank market or with other RFEDs. This practice allows the RFED to manage its own risk exposure that arises from acting as a counterparty to its customers' trades. While netting customer transactions internally is part of how an RFED functions as a principle, placing external offsetting trades is the common method for hedging. Holding all customer positions unhedged would expose the RFED to unacceptable risk. This method ensures efficient risk management for the RFED while fulfilling customer orders. Question 19. What is slippage in forex trading? A. The amount of profit a trader makes on a successful trade. B. The difference between the expected price of a trade and the price at which the trade is actually executed. C. The overnight interest rate charged on leveraged positions. D. A software error causing a trade to be executed incorrectly. Answer B. The difference between the expected price of a trade and the price at which the trade is actually executed. Explanation. Slippage occurs when a trade is executed at a price different from the one requested by the trader, typically due to rapid market movements or insufficient liquidity. This difference can be either positive, better price, or negative, worse price, than the intended execution price. Slippage is particularly common during volatile news events or when trading exotic currency pairs. Traders must be aware of slippage as it can impact the profitability and risk management of their strategies, especially with market orders or stop-loss orders in fast-moving markets. Question 20. A customer initiates a withdrawal request from their retail forex account. Under NFA rules, how quickly must the RFED generally process the withdrawal? Within 1 business day. B. Within 2 business days. C. Within 5 business days. D. As soon as administratively possible without undue delay. Answer. D. As soon as administratively possible without undue delay. Explanation. NFA Compliance Rule 2-36E dictates that an RFED must process customer withdrawal requests as quickly as administratively possible and without undue delay. While there isn't a specific numerical day limit, the emphasis is on promptness. RFEDs are expected to have efficient procedures in place to ensure timely access to customer funds. Delays in processing withdrawals without valid reasons can lead to NFA disciplinary action, as customer access to their funds is a fundamental protection. This rule aims to prevent firms from holding customer funds hostage. Question 21. Which of the following actions is prohibited for an associated person AP of an RFED regarding customer complaints? A. Directing a customer to submit a complaint to the NFA. B. Attempting to resolve a complaint directly with the customer. C. Altering or destroying a customer complaint record. D. Escalating a complaint to the firm's compliance department. Answer. C. Altering or destroying a customer complaint record. Explanation. Altering or destroying customer complaint records is a serious violation and strictly prohibited for an associated person AP of an RFED. All complaints must be accurately recorded and maintained in accordance with NFA record-keeping rules. Customer complaints are vital for regulatory oversight and for firms to identify and address systemic issues. Attempting to resolve complaints or escalating them appropriately are acceptable procedures. Tampering with records undermines regulatory integrity and can lead to severe penalties, including industry bars. Question 22. Which of the following statements accurately describes positive slippage in forex trading? A. It is a situation where a trade is executed at a less favorable price than expected. B. It represents a risk of missing a profit target due to market volatility. C. It occurs when a trade is executed at a price more favorable to the trader than the requested price. D. It is a type of technical error that can lead to incorrect trade execution. Answer. C. It occurs when a trade is executed at a price more favorable to the trader than the requested price. Explanation. Positive slippage occurs when a trade is executed at a price more favorable to the trader than the requested price. This is generally considered beneficial for the trader, as it improves the trade's profitability. It is the opposite of negative slippage, which results in a worse execution price. Therefore, there is no inherent risk associated with positive slippage. Rather, it is a favorable outcome. Question 23. An RFED must file financial reports with the NFA. How often are these reports typically required? Daily. B. Weekly. Monthly. D. Quarterly. C. Monthly. Explanation. Retail foreign exchange dealers, or FEDs, are required to file monthly financial reports with the National Futures Association, NFA. These reports provide crucial financial information, including adjusted net capital computations, to ensure that RFEDs continue to meet the stringent financial requirements set by the NFA. Regular and timely submission of these reports is essential for regulatory compliance and for the NFA to monitor the financial health and stability of its member firms. Failure to file on time or accurately can result in disciplinary action. Question 24. Which factor is least likely to be considered by an RFED when determining the suitability of retail forex trading for a customer? A. Customer's investment experience. B. Customer's financial situation, including net worth and liquid assets. C. Customer's risk tolerance. D. Customer's preferred political party affiliation. Answer: D. Customer's preferred political party affiliation. Explanation: Suitability standards for retail forex trading focus on a customer's financial capacity, investment knowledge, and willingness to accept risk. Factors like investment experience, financial situation, e.g., net worth, liquid assets, and risk tolerance are all critical components in assessing whether forex trading is appropriate for an individual. A customer's political party affiliation has no bearing whatsoever on their financial suitability for trading and is therefore irrelevant. RFEDs must ensure that they only onboard customers for whom leveraged forex trading is genuinely suitable. Question 25. What is the key difference between a limit order and a stop order in forex trading? A. A limit order executes immediately at the best available price, while a stop order waits for a specific price. B. A limit order specifies a price to buy below market or sell above market, while a stop order triggers a market order once a certain price is reached. C. Limit orders are used for profit-taking, and stop orders are used for entry. D. Limit orders expire daily, while stop orders remain active indefinitely. Answer: B. A limit order specifies a price to buy below market or sell above market, while a stop order triggers a market order once a certain price is reached. Explanation: A limit order is an instruction to execute a trade at a specific price or better. It allows buying at or below a specified price or selling at or above a specified price. Conversely, a stop order is an instruction that becomes a market order once a specific stop price is reached, typically used to limit losses or protect profits on an existing position. The key distinction lies in how they interact with the market. Limit orders seek a better price, while stop orders convert to market orders to ensure execution once a threshold is crossed. Understanding these order types is fundamental for trade execution and risk management. Question 26. If an RFED is found to be deficient in its anti-money laundering (AML) program, which U.S. government agency would most likely impose a fine? A. The National Futures Association, NFA. B. The Financial Crimes Enforcement Network, FINCEN. C. The Commodity Futures Trading Commission, CFTC. D. All of the above, depending on the severity and nature of the deficiency. Answer: D. All of the above, depending on the severity and nature of the deficiency. Explanation: While FINCEN is the primary agency responsible for enforcing AML regulations across the U.S. financial system, both the NFA and CFTC also have authority over their regulated entities, including RFEDs, regarding AML compliance. The NFA conducts examinations and can bring disciplinary actions for AML rule violations, while the CFTC provides the overarching regulatory framework for futures and forex markets, which includes AML requirements. Therefore, depending on the specific violation and its severity, any or all of these bodies could impose fines or other penalties. This multi-layered regulatory approach reinforces the importance of robust AML programs. Question 27. An associated person (AP) of an RFED makes a personal trade in a currency pair shortly after placing a large customer order in the same pair, benefiting from the price movement caused by the customer's order. This action is known as hedging. B. Arbitrage. C. Front-running. D. Scalping. D. Front-running. Explanation: Front-running is a prohibited and unethical practice where an individual or firm uses non-public information about an impending large customer order to place a proprietary trade ahead of it. By doing so, the AP aims to profit from the anticipated price movement caused by the customer's order, effectively trading against the customer's best interest. This activity violates an AP's duty of fairness and integrity and is strictly prohibited by NFA rules. It undermines market fairness and trust in the financial industry. Question 28. What is a pip in the context of forex trading? A. A unit of measurement for trading volume. B. The smallest price increment for a currency pair. C. A type of order used for rapid execution. D. A slang term for a profitable trade. Answer: B. The smallest price increment for a currency pair. Explanation: a pip, percentage in point, is the smallest unit of price movement for a currency pair, representing the fourth decimal place for most pairs, e.g., 0.0001, or the second decimal place for JPY pairs, e.g., 0.01. Pips are crucial for calculating profits, losses, and spreads in forex trading. Understanding pips is fundamental to calculating the value of trades and assessing the costs associated with trading. Traders use pips to quantify their gains and losses and to set their stop-loss and take-profit levels. Question 29. An RFED must establish and maintain a business continuity plan, BCP. What is the primary purpose of this plan? A. To ensure maximum profitability during market downturns. B. To attract new customers by demonstrating stability. C. To ensure continuity of critical operations and customer access to funds during disruptions. D. To guarantee all customer accounts are fully insured against loss. Answer: C. To ensure continuity of critical operations and customer access to funds during disruptions. Explanation: a business continuity plan, BCP, is a mandatory requirement for RFEDs, designed to ensure that critical operations, including trade execution, record-keeping, and customer access to funds, can continue during significant business disruptions. Disruptions can range from natural disasters to technological failures. The primary purpose is to protect customer interests by minimizing service interruptions and safeguarding assets. A robust BCP demonstrates an RFED's commitment to operational resilience and regulatory compliance, which is essential for maintaining market integrity and customer confidence. Question 30. According to NFA rules, an RFED is required to obtain specific information about a prospective customer's financial situation. Which of the following is explicitly required? Employment history for the last 10 years. B. Net worth and liquid assets. C. Credit score from all three major bureaus. D. Annual household income only. Answer: B. Net worth and liquid assets. Explanation: NFA rules for RFEDs mandate that firms gather specific financial information from prospective customers to assess their suitability for forex trading. Key among these are the customer's net worth and liquid assets, as these directly relate to their ability to sustain potential losses in leveraged trading. While other financial details might be considered, net worth and liquid assets are explicitly required to determine if the customer can truly afford the risks involved. This information is vital for the RFEDs' Know Your Customer and suitability obligations. Question 31. What does negative equity protection mean for retail forex traders as mandated in certain jurisdictions, though not explicitly by NFA for all RFEDs but good practice? A. The RFED guarantees a minimum profit on all trades. B. The customer cannot lose more than their initial deposit. C. The RFED covers any losses beyond the initial margin required for a position. D. The customer's account balance cannot fall below zero, preventing them from owing the broker money. Answer: D. The customer's account balance cannot fall below zero, preventing them from owing the broker money. Explanation: negative equity protection is a policy that ensures a retail forex trader's account balance cannot fall below zero, meaning they cannot lose more money than they have deposited in their trading account. If market movements cause losses that exceed their account balance, the broker absorbs the additional loss, preventing the customer from owing the broker money. While not universally mandated by the NFA for all RFEDs, it is a significant customer protection feature offered by many brokers, especially in other regulated jurisdictions. This protection mitigates the extreme risk of debt for leveraged retail traders. Question 32. An RFED must retain certain records for a specified period. What is the minimum record retention period for most general business records under NFA rules? 3 years. B. 5 years. C. 7 years. D. 10 years. Answer B. 5 years. Explanation. NFA Compliance Rule 2 to 10 generally requires RFEDs to retain most business records, including communications, account statements, and trade confirmations for a minimum of 5 years. These records must be readily accessible for the first 2 years of the retention period. This extensive record-keeping requirement is critical for regulatory oversight, allowing the NFA to monitor compliance, investigate complaints, and reconstruct trading activity if necessary. Adherence to these retention rules is a fundamental aspect of an RFED's operational and compliance responsibilities. Question 33. What is the primary objective of the Dodd-Frank Wall Street Reform and Consumer Protection Act concerning retail forex in the U.S.? A. To deregulate the retail forex market to encourage competition. B. To increase leverage limits for retail traders. C. To enhance consumer protection and reduce systemic risk in the financial system, including retail forex. D. To promote off-exchange forex trading for all investors. Answer. C. To enhance consumer protection and reduce systemic risk in the financial system, including retail forex. Explanation. The Dodd-Frank Act, enacted in response to the 2008 financial crisis, significantly reformed the U.S. financial regulatory landscape, with a strong emphasis on enhancing consumer protection and reducing systemic risk. For retail forex, it introduced stricter regulations, including higher capital requirements for RFEDs, restrictions on leverage, and greater oversight by the CFTC and NFA. Its objective was to curb abusive practices and provide a more secure environment for retail participants. This legislation fundamentally reshaped how retail forex is conducted in the United States. Question 34. Before seeking to offset aggregated customer positions with external liquidity providers, what is a fundamental internal risk management practice an RFED performs? A. Speculating on the market direction with a portion of the aggregate customer exposure. B. Categorizing and netting customer trades by currency pair and direction to determine net exposure. C. Requiring all customers to maintain a minimum account balance of $25,000. D. Only processing customer trades during periods of low market volatility. Answer. B. Categorizing and netting customer trades by currency pair and direction to determine net exposure. Explanation. A fundamental internal risk management practice for an RFED is to categorize and net customer trades by currency pair and direction. This process allows the RFED to determine its overall net exposure across all customer positions. Once the net exposure is calculated, the RFED can then decide how to manage this residual risk, typically by entering into offsetting trades with external liquidity providers. This internal netting process is crucial for efficient risk management before external hedging. Question 35. Beyond initial customer onboarding, what is a crucial ongoing component of an RFED's anti-money laundering (AML) and Know Your Customer (KYC) program? A. Conducting annual surveys to gauge customer satisfaction with trading performance. B. Periodically reviewing customer account activity for suspicious patterns, changes in financial behavior, or updated suitability information. C. Requiring all customers to resubmit their identity verification documents annually. D. Providing personalized investment advice based on observed trading habits. Answer. B. Periodically reviewing customer account activity for suspicious patterns, changes in financial behavior, or updated suitability information. Explanation. An effective AML and KYC program extends beyond initial onboarding. RFEDs are required to conduct ongoing monitoring of customer account activity to detect and report suspicious transactions, identify changes in a customer's financial situation or trading objectives that might impact suitability, and update customer information as necessary. This continuous review is essential for combating financial crime and ensuring ongoing compliance with regulatory requirements.